This ETF has already paid out more cash per share than many funds ever will, yet an investor who arrived at launch and counted every distribution is still underwater. That is the uncomfortable puzzle on today's table. When a fund sends you a torrent of cash while the investment itself collapses, are you earning income or just receiving pieces of your own account back in weekly envelopes? Today we're dissecting the Granite Shares Yield Boost Coin ETF, ticker COYY, using data through August 21, 2026. This is not a conventional dividend portfolio. It is an actively managed derivative income fund built around the daily price performance of Coinbase Global Inc., ticker COYY. Its mandate combines two aggressive ideas: seek current income through options while targeting daily 2x exposure to a single, highly volatile stock. In plain English, this machine is designed to magnify short-term movement and turn option pricing into cash payments. That can create spectacular-looking deposits when volatility is rich. It can also make the fund's capital base absorb losses faster than the distributions can repair them. The key distinction is between cash flow and wealth creation. A payment can be real cash in your account without being economic profit. If the strategy earns option premium, loses more through its market exposure, and then keeps distributing cash anyway, the payment statement looks healthy while the underlying investment gets thinner. Our job is to separate those moving parts and determine what holders actually kept. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold any security. ETFs can lose value, including funds designed to produce income. Verify the current prospectus, shareholder reports, distribution notices, tax documents, and other official fund materials, because strategies, holdings, payments, and risks can change. Consult a qualified professional who understands your circumstances before making financial, tax, or legal decisions. Let's check the vitals. The fund launched on July 28, 2025. It pays weekly, charges a 1% expense ratio, and manages $18 million in assets. That profile matters before we even reach the payout. Weekly cash flow may appeal to investors who like frequent deposits, but payment frequency does not make the underlying economics safer. It simply divides whatever the fund chooses to distribute into more calendar events. The expense ratio is another persistent drag. The strategy must overcome its operating cost before holders come out ahead. Asset size matters operationally too. A smaller fund can still function perfectly well, but investors should pay attention to trading spreads, liquidity, and whether the issuer continues to support it. Those questions are separate from strategy performance. A clever mechanism can trade efficiently and still lose money. A liquid market can make it easy to enter an unattractive proposition. For a buyer looking at the fund now, the honest lead number is a 74% current run rate. That comes from annualizing the latest 4 payments and asking what the next stretch would look like if those payments repeated. It is extreme, but it is not a promise, and it should not be mistaken for an expected total return. The trailing 12-month yield is 400%. That is history, not today's available income rate. The gap is enormous because the trailing calculation still contains much larger payments from earlier in the fund's life. Quoting that larger figure as the current opportunity would be like advertising last season's flood after the river has already receded. There is another useful lens. Annualizing only the single latest payment produces 63%. That sits below the latest 4 run rate because the most recent check was smaller than the recent average. None of these analyzations tells us what the next payment must be. They are snapshots built from distributions that the board can change and that market conditions can reshape. A high distribution rate also says nothing by itself about where the money came from. Option premium can contribute. Realized trading results can contribute. Capital can be returned. What matters is whether the fund's net asset base and distribution-inclusive result show that the strategy created enough value to support the cash leaving the portfolio. That evidence comes later in the autopsy, and it is where the headline rate loses its shine. Time for the history. The latest distribution was 20 cents per share. The first 4 average was 448 cents per share, while the latest 4 average was 24 cents per share. The authoritative direction is down. The recent average is only 5% of the launch period average. That decline is the central income story. Early holders saw unusually large weekly deposits, but a buyer today is stepping into a radically different payment regime. The trailing yield remains inflated because it looks backward across those early checks. The run rate looks forward only by assumption, and even that recent level has no contractual floor. This is why distribution history should be read as a sequence, not compressed into one annual percentage. A single yield figure hides the path. Here, the path says the fund began with an extraordinary payout pace and then reset sharply lower. That does not prove the next check will fall again, but it does prove that the launch pace was not durable through the period provided. Investors using weekly payments for spending have a second risk beyond market losses: cash flow instability. Bills arrive on schedule, option results do not. If the portfolio's premium opportunity changes, if the underlying moves violently, or if the fund preserves more capital, the deposit can change. Anyone treating a variable distribution like a paycheck is matching a flexible asset to a rigid liability. Now we examine the body, starting with net asset value. The launch reference price was $150.75. The latest NAV and price is $16.68, producing a negative 89% NAV return since inception. The maximum drawdown was also negative 89%. That path is not a gentle sacrifice of growth in exchange for income. It is a collapse in the capital base. A chart can sometimes make repeated declines look less alarming after the scale compresses, but the investor experience is straightforward. The fund had far less value left to generate future returns and distributions. NAV is the productive tissue of an income fund. When it shrinks, the strategy is working with a smaller base. Even if future option premiums remain attractive relative to that base, a large percentage payment on a depleted account may translate into much less cash than an early holder once received. This is one reason a distribution percentage can stay visually dramatic while the holder's financial position deteriorates. The path also exposes sequence risk. A leveraged daily objective can be especially punishing when the underlying whipsaws. Gains and losses compound from a newly reset base each session, so reversing moves do not neatly cancel. A fall followed by a rebound can leave the leveraged path behind the simple starting point, even before fees and distributions. That is a structural issue, not merely a bad headline on one day. A rebound in the underlying could help the fund's exposure, but recovery math becomes harsher after deep losses. Meanwhile, cash already distributed is no longer inside the portfolio participating in any recovery. The investor may have spent it, reinvested it, or paid tax depending on account and classification, but the fund cannot use the departed cash to rebuild NAV. Price alone is not the whole verdict, because holders did receive $80.58 per share in cash distributions since launch. So we add those payments back using the provided simple distribution-inclusive measure. The result is negative 35% since inception. That is better than looking at the price decline alone, and fairness requires saying so. The cash softened the damage substantially, but it did not turn the experience into a gain. An investor could collect a remarkable stream of deposits, watch them appear as settled cash, and still end with less combined value than at the beginning. This is the accounting trap at the heart of high distribution products. Brokerage interfaces often separate income received from market value, encouraging the eye to celebrate one panel and ignore the other. Total return reunites them. It asks the only question that can adjudicate the story. After counting both what remains and what was paid out, did the investment create wealth? Reinvestment would change an individual holder's path, as would purchase timing, taxes, and trading prices. But none of those possibilities rescues the since-launch evidence presented here. Reinvesting cash into the same declining vehicle does not magically convert losses into earnings. A later buyer gets a new starting point, not a rewritten history. Here is the machine under the hood. The listed portfolio consists of United States Treasury bills at 63% and US dollars at 38%, plus 4 put options the fund writes for premium income. There is no stated index. The COMM collateral supports an aggressive derivative position tied to the underlying company. When the fund writes a put, it receives premium up front. In exchange, it accepts an obligation connected to the underlying share price. If the stock stays above the option's strike through the relevant period, the option may expire without a costly settlement and the fund keeps the premium. If the stock drops through that strike, the obligation can become expensive because the fund is effectively exposed to buying or settling against a falling asset at less favorable terms. That premium is the income factory. Volatile stocks tend to carry richer option prices because the market expects wider movement. Richer premium can support larger distributions, which is why this design can look so compelling on an income screen. But premium is compensation for assuming risk, not free interest. The other side pays because the protection has value. The daily leverage target adds another layer. The fund is seeking magnified exposure for each trading day, not promising to deliver a simple doubled result across months or years. Daily resets mean the long-period outcome depends on the exact order of moves. A smooth rise may behave very differently from a jagged route that ends near the same place. Volatility therefore plays two roles. It can make the options sold more lucrative, while also making the leveraged path more vulnerable to compounding damage. Consider a general stress scenario. The underlying falls quickly before the written puts expire. The options the fund sold become liabilities just as the directional exposure is suffering. The premium cushions part of the hit, but only up to the premium collected. It does not provide unlimited protection. What should an investor watch from here? First, track the next several payments as dollars and cents per share, not just an annualized website badge. The key question is whether recent cash flow stabilizes, keeps falling, or recovers in a way that is supported by portfolio results. Second, pair every distribution update with the NAV path. If cash arrives while NAV continues to deteriorate, the apparent income may still be failing the wealth creation test. A healthier period would require the value retained, and the value distributed to work together rather than one disguising damage in the other. Third, inspect current holdings and option disclosures. Look at strike prices, expirations, notional exposure, collateral, and any changes in how the fund reaches its daily objective. The number of contracts alone cannot reveal the risk. The terms and size of those obligations determine how the portfolio responds. Fourth, monitor the underlying's volatility and direction. Calm or favorable conditions can help premium harvesting, while a sharp decline can make written protection costly. Choppy reversals deserve attention too, because daily leverage can suffer even when the longer period end point looks deceptively ordinary. Fifth, read distribution notices and year-end tax documents rather than guessing from the cash deposit. Option income, realized gains, and return of capital are economically and potentially tax-wise different. The final classification can arrive after the payment itself. Finally, compare the fund with the simpler alternatives that match the investor's real objective. Direct exposure if the goal is upside participation, a diversified income fund if the goal is broader cash flow, or genuinely low-risk assets if the goal is capital stability. The right comparison is not whichever product displays the largest yield. It is the cleanest tool for the job. Cause of death: NAV erosion. The evidence is decisive because the cash did not compensate for the capital destruction. The distribution history began at a pace that did not persist. The remaining asset value was devastated, and even after giving full credit to every payment in the supplied record, the holder's combined result stayed deeply negative. The fund delivered cash flow, but much of that flow functioned as the holder's own capital coming back. That does not mean the options were imaginary or that every future buyer must have the same experience. It means the since launch machine failed the essential test for an income investment, preserving enough value that the payout represents sustainable economic production rather than liquidation in installments. For a highly tactical trader who understands single stock derivatives, daily leverage, variable distributions, and path dependence, this may be a deliberate speculation. For an everyday investor seeking dependable income and durable principal, the evidence presented here points the other way. Do not ask only, how much did it pay? Ask, after it paid me, how much of my investment was actually left? 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.